Gold doesn't need a new story to go higher. The inflation tape is already changing, and the bond market is quietly admitting it. The conflict is simple. The mainstream keeps chanting, disinflation, soft landing, nothing to see, while traders who live inside break-evens, real yields, and spreads are watching the floor under gold get stronger by the day. And the hidden mechanism most people miss isn't it some spooky headline at all. It's the way inflation expectations are bending across the curve, right? And as the calendar forces hedgers and funds to act. Stay with me, because by the end, you'll have a clean near-term roadmap for what matters over the next week or two. The levels that decide whether this move pauses, squeezes, or snaps back, and the one signal that usually shows up before the crowd even realizes the regime changed. And that's where the real pressure starts. Let's put the hype away and look at what price is actually saying right now. Gold has been living in a high altitude range this month, surging from roughly the low $40,300 earlier in January toward the mid-4600s, with prints that have flirted with new highs. That's not a gentle grind, that's fast repricing. And fast repricing is rarely everyone suddenly got emotional. Fast repricing is usually mechanics. Somebody got off sides, funding got tighter, hedging flows got heavier, or the market collectively realized the old assumptions were underpriced. But that's not the part that matters. The part that matters is what kind of repricing this is. Is it the classic safe haven pop that fades the moment headlines calm down? Or is it the quieter, more durable kind of move where inflation expectations shift, real yields stop cooperating, and gold becomes the pressure valve for credibility risk? Because if this one setup is real, gold doesn't need daily drama to keep leaning higher. It just needs the math to keep working. So let's talk about that math in a way you can actually use. Here's the core principle. Gold doesn't trade inflation in isolation. Gold trades inflation expectations relative to the real return you can earn by holding paper. In plain English, the competition for gold isn't your neighbor's stock portfolio. The competition is the risk-free promise. What do you get after inflation if you just sit in high-quality bonds? When that after-inflation return looks juicy, gold has to work harder to justify itself. When that after-inflation return looks fragile or politically risky, gold suddenly looks cheap, even if it's already expensive on a chart. And the market doesn't wait for a CPI print to make that decision. The market prices the path. The market prices the credibility. The market prices the probability that inflation runs above target longer than the official story says. And that's why inflation expectation shifting is such a big deal for gold traders. But there's a trick embedded in that phrase, inflation expectations. Most people imagine it like a single thermometer reading. It's not. It's a curve. It's a strip of prices across time. And right now, the curve is doing something that changes the entire setup. Here's the hidden detail. Inflation expectations are not moving as one blob. The near term and the medium term don't always agree with the long term. And when they diverge, gold reacts to that gap. Think of it like a credit spread inside the inflation market. When the market says, I'm okay with long-run inflation around target, but I'm not comfortable about the next few years, that's a very specific kind of fear. It's not apocalypse fear. It's credibility and policy path fear. We might get sticky inflation, messy supply shocks, and a central bank boxed in by politics, deficits, or growth. That's the fear that makes people pay up for inflation protection, even while the headline inflation numbers can look calm for a moment. And that is the fear that tends to give gold a bid that doesn't vanish overnight. But let's make it concrete. In the US market, one of the cleanest public windows into inflation expectations is break-even inflation, the difference between nominal treasury yields and TIPS yields. It's not perfect. It is not pure expectation. There is a risk premium and liquidity premium baked in, but it S the marketplace, S live scoreboard. When break-evens tick up, it's the market saying it wants more compensation for future inflation. When real yields tick up, it's the market saying you can earn more after inflation by holding inflation-protected paper. Gold sits in the middle of those forces, and right now, that middle is tense. Here is what recent data has been implying. The 5-year break-even has been living in the mid 2% area, while real yields on intermediate tips have been positive and not trivial. That combination tells you something important. Inflation expectations are not collapsing, and real returns are still there, which means gold's strength isn't coming from a simple rates down, gold up story. It's coming from something more layered. Uncertainty about the rate path, uncertainty about inflation persistence, and a growing premium for monetary credibility. And that's where the next detail flips the whole setup. Because when gold rips in an environment where real yields are still meaningfully positive, you have to ask, who is buying and what are they hedging? That question forces you into market structure, not vibes. Gold is not just a spot market. It's a futures market with delivery mechanics. It's an options market with hedging flows. It's a physical market with vault constraints and logistics. And when all of those layers start leaning in the same direction, price can move in a way that looks unreasonable, right up until it becomes the new normal. So let's stack proof the way a serious trader would. First proof point, the price structure itself. A move from the low 4300s toward the mid 4600s inside a few weeks, with repeated attempts to hold elevated levels, is a regime signal. Not because up means up forever, but because it often shows you demand is stepping in on dips rather than fading strength. The market is behaving like it has a buyer with patience. And patient buyers don't come from headlines, they come from mandates. That's the first pressure. Second proof point, the calendar. This is the why now that people ignore because it sounds boring until it moves your P&L. Late January compresses liquidity and concentrates positioning decisions. Month-end flows start whispering, funds start marking books, risk managers start tightening leashes, and importantly for gold, options expirations and hedging schedules create mechanical flows. For example, gold options tied to major contract months have specific last trade and settlement dates right around the end of January for the February contract. When you get close to those dates, open interest that's been sitting quietly can suddenly become urgent. Dealers who sold options have to hedge. Traders who own options either monetize or roll. Funds with systematic rules adjust exposures. And in thin liquidity, those actions have outsized impact. This isn't a conspiracy, it's plumbing. The market's pipes narrow, the same volume pushes harder, and price discovery jumps. But that's not the part that matters. The part that matters is what kind of options environment we are in when that calendar pressure hits. If positioning is one-sided, a small move can trigger a chain reaction. If implied volatility is elevated and dealers are short gamma in key strikes hedging, can turn into forced buying into strength and forced selling into weakness. Exactly the kind of reflexive behavior that creates those, how is it still going? Days. Let me explain that mechanism cleanly without turning this into a textbook. When a dealer sells a call option, they're short the upside. If price rises, they lose money unless they hedge by buying the underlying. The higher price goes, the more they need to buy to stay hedged. That's delta hedging. When the sensitivity of delta to price is high, gamma is high, those hedging flows can accelerate the move. It's like trying to run downhill while someone keeps nudging you forward. The market can feel like it's being pulled by an invisible rope. And here is the punchline. You don't need everyone to be bullish for this to happen. You just need enough options positioned around key strikes and a calendar window that forces action. And that's where the real pressure starts. Third proof point, institutional behavior in the real world, not the commentariat. Central banks have been adding gold to reserves for years, and that demand tends to be slow, sticky, and less price sensitive than retail trading. It's not about catching a dip. It's about reducing exposure to sanctions risk, diversifying reserves, and holding an asset that doesn't depend on someone else's promise. When that flow is present, it changes the market's elasticity. It doesn't guarantee a straight line up, but it does mean dips can be shallower because a different class of buyer shows up with different incentives. And in recent commentary and surveys from major gold industry groups, central banks consistently cite gold's role as a strategic reserve asset, especially in a world where geopolitical friction and currency credibility are live issues. That matters because it's demand that doesn't need a bullish chart to justify itself. But that's not the part that matters. The part that matters is how that demand interacts with paper markets during stress, because gold is one of the few assets where paper and physicals can decouple at the margins. You can see it in spreads, in lease rates, in the way futures trade relative to spot, and in the way physical premiums behave regionally. You don't have to be dramatic about it. You just have to respect that futures are promises with delivery rules, and physical is metal with logistics. Fourth proof point, the futures curve and carry signals. Normally, gold tends to trade in contango. Future prices a bit higher than spot because there is a cost of carry, storage, insurance, financing. When the market gets tight or when the convenience of holding physical rises, that structure can flatten or, in rare moments, invert in certain tenors. Even if you don't have the exact curve in front of you, you can watch the concept. If spreads start screaming, front-month strength, tightness into delivery windows, that's the market telling you immediate metal has a premium. And when immediate metal has a premium, paper narratives usually follow, not lead. Fifth proof point, the ETF wrapper. When large pools of capital want gold exposure fast, they often buy the wrapper, gold-backed ETFs, because it's frictionless. Those vehicles publish their holdings and are designed to reflect metal exposure. When flows into the wrapper increase, authorized participants create shares, and that process can pull on physical supply in a mechanical way. Again, not magic, just structure. If a broad audience of portfolio managers decides that inflation expectations are not as solved by as the official story suggests, ETF flows can become a pipeline from macro fear into physical demand. And here is the uncomfortable truth. ETF flows can move faster than mines and refineries can respond. Which takes us to the sixth proof point, supply chain reality. Gold supply is not like flipping a switch. Mines have years-long development timelines, regulatory gates, and geological constraints. Recycling helps, but it's not infinite, and it often depends on consumers' willingness to part with metal, which can actually decline when people distrust fiat. Refining and logistics have bottlenecks. In the short run, supply is relatively inelastic. So when demand shifts quickly, price is the balancing mechanism. That doesn't mean to the moon. It means the market clears through price, not through an overnight surge in supply. And that's where the real pressure starts. Now, you might be thinking, okay, but isn't this just another safe haven wave? Geopolitics, tariffs, central bank drama, the usual. And yes, those headlines can add fuel. But here is the more finance-literate way to frame it. Even if you strip away the sensational news, you still have a clean macro regime question sitting underneath gold. The question is not, is inflation high today? The question is, what is the distribution of inflation outcomes over the next few years? And how credible is the policy response if inflation reaccelerates? That's a probability question. That's a risk premium question. And risk premia can reprice fast. This is where inflation expectations shift, becomes the setup gold traders watch, because it's the bridge between the data and the regime. A single CPI print can be noisy. A sustained move in break-evens, coupled with stubbornly positive real yields in a gold market that refuses to give back gains, is a signal that the market is paying for tail risk. And when markets pay for tail risk, they don't do it politely. They do it in bursts, they do it in squeezes, they do it in gaps. And that's why your job as a viewer is not to become a cheerleader. Your job is to become a process machine. Because volatility is going to try to manipulate you. Let's talk about that manipulation openly, because this is where most retail investors get emotionally mugged. When an asset like gold is in a high volatility regime, it will do two things that feel personal. It will rip without you, and then it will dump right after you buy. It will create the illusion that you're always late. That's not the market targeting you. That's your nervous system reacting to randomness plus leverage in the system. The market's job is to discover price. Your brain's job is to avoid pain. Those goals conflict. And the easiest way to lose money in a high volatility regime is to confuse noise for signal. Noise is a 1 to 2-day swing that doesn't change the macro inputs. Signal is a break in the relationship between gold, break-evens, and real yields, or a visible change in spreads and funding that tells you something structural shifted. If you treat every red candle like the end of the thesis, you'll churn yourself into exhaustion. If you treat every green candle like confirmation of genius, you'll oversize at the top. That's where the real pressure starts. So here's your viewer psychology shield, simple and usable. 1, decide your time horizon before price decides it for you. Are you watching this as a 1 to 2 week tactical trade around month-end and options flows, or as a multi-month macro hedge against credibility risk? Those are different games with different invalidations. 2, define your invalidation based on mechanisms, not feelings. If your thesis is inflation expectations are shifting higher and real yields won ODT crush gold, then the invalidation is not gold dipped 80. The invalidation is something like real yields break higher and stay higher while break-evens roll over, or gold fails to hold key structural support and the curve relaxes. 3, accept that even if you're right, price can whip around violently. In fact, in reflexive markets, the whip around is part of the process. It's how leverage gets cleaned out. It's how weak hands hand the baton to stronger hands. You don't have to romanticize it, you just have to plan for it. Now let's turn this into a near-term roadmap, because interesting macro discussion doesn't pay bills unless you can translate it into what to watch next. Over the next week or two, you want to watch 3 dashboards: inflation expectations, real yields, and volatility. If 5-year break-evens stay firm or grind higher while real yields fail to surge, that's supportive. If break-evens soften sharply while real yields jump, that's the kind of combo that can punch gold in the mouth. And volatility matters, because it tells you how the options machine is positioned. If implied volatility stays elevated while price holds up, that can be a sign that the market is still paying for upside and downside tails, meaning hedging demand is alive. If implied volatility collapses while price stalls, that can be a sign that the panic bid is fading and the market is transitioning into a slower phase. But that's not the part that matters. The part that matters is how these inputs show up in price levels, because levels are where behavior changes. Let's talk levels in a practical way without pretending we can predict the future. In a market that's been pressing record territory around the mid-4,600s, there are usually 2 kinds of levels that matter. The obvious ones are round numbers and recent highs. Areas like 4,600, 4,650, 4,700 dollars as psychological magnets. The less obvious ones are the zones where the market previously accelerated, breakout areas, and decision shelves where volume and positioning built up. In this month's action, the low to mid 4,300s region matters. because it was a reference point for the recent leg higher. And it often becomes the first line in the sand for whether a pullback is a retest or a trend break. You don't need perfect precision, you need a framework. If price pulls back but holds above the prior breakout zone and then reclaims momentum, that's a controlled retest. If price slices through that zone and fails to reclaim it on the bounce, that's the market telling you the fast money bid is backing away. And that's where the real pressure starts. Now, there is one more hidden detail in this setup that a lot of people miss because they be too focused on spot price, the inflation curve kink I mentioned earlier. Here's how you watch it without becoming a rates quant. Compare how medium-term break-evens behave relative to longer-term expectations. If medium-term break-evens are sticky while long-term stays anchored, that suggests the market is pricing near-term inflation risk but still believes the long-run target survives. That's the sticky inflation, messy policy regime. Gold often thrives there because it's not competing against a clean, confident, real return story. It's competing against a story full of caveats and political constraints. But if long-term expectations start drifting higher too, that's a different regime. That's where the market is questioning the anchor itself. That tends to be even more supportive for gold, but it can also come with more violent drawdowns because the policy response risk is higher. Either way, the shape matters, the kink matters, because it tells you whether gold is being bid as a short-term panic hedge or as a longer-term credibility hedge. And if you understand that, you stop getting whiplash every time a headline tries to hijack your attention. Now let's be honest about the counterpoints, because trust is built when you name what could go wrong. The biggest counterpoint to a bullish gold setup is a sharp and sustained rise in real yields. If real yields climb meaningfully and stay elevated, the opportunity cost of holding gold increases. That can cap rallies and trigger deeper pullbacks. Another counterpoint is a sudden, broad, risk-on surge where liquidity floods equities and credit, the dollar strengthens, and hedge demand fades. Another is positioning. If too many traders crowd into the same long, the market can punish them with a brutal shakeout, even if the broader trend remains intact. And there's the simplest counterpoint of all, markets overshoot. Gold can run too far, too fast, and then mean revert hard. That doesn't disprove the macro, it just means timing matters. So if you're watching this, don't marry one outcome. Hold two, because the two scenario lens is how you stay sane. Scenario one is the controlled pullback and retest. In this scenario, gold cools off, pulls back toward that prior breakout shelf, think the low to mid $4,300 zone, and finds buyers. Break-evens stay firm, real yields don't spike, and volatility either stays supported or drifts down slowly without collapsing. Price chops, shakes out late longs, then resumes higher as the calendar pressure resolves and the market transitions into the next leg. This is the scenario where patience wins and chasing loses. Scenario two is the continuation squeeze. In this scenario, gold doesn't give the market the pullback it wants. It holds high, liquidity stays thin, and options hedging flows amplify upside moves into the end of January window. You get gap risk. You get those days where it feels like price is climbing a wall of disbelief. In that scenario, resistance zones like the mid 4600s and above can break and turn into support quickly, and the market can start talking about the next big psychological handle. But, and this is the part everyone ignores, that scenario also comes with a nasty boomerang risk. When squeezes run out of fuel, they don't end politely. They end with air pockets. That's why you don't size like a hero. That's why you plan your exits and your invalidation. And that's where the real pressure starts. So what confirms the thesis in the near term? Watch for gold holding elevated levels into key calendar dates without break-evens collapsing. Watch for real yields failing to surge even as nominal yields wobble. Watch for signs that the paper market is staying tight. Front-end strength, stubborn volatility, persistent demand in the wrapper. Watch for dips that get bought quickly, especially if they coincide with a risk-off day where you expect gold to fade, but it refuses. Those are tells. And what weakens it? A clear breakdown through the prior breakout shelf with no quick reclaim, accompanied by break-evens rolling over and real yields pushing higher. That combination is the market saying the inflation premium is coming out and paper is paying you again. In that world, gold can still be a long-term hedge, but the tactical setup changes. You stop treating dips as gifts and start treating rallies as opportunities to reduce risk. That's a different posture. And if you can shift postures without ego, you're already ahead of 90% of the crowd. Now, a quick word about institutional suppression or narratives, because I know a big part of this audience is skeptical of institutions and wants to call everything manipulation. Here's the disciplined way to talk about it without stepping into fantasy. Markets don't need a villain to behave unfairly. They just need incentives. Dealers hedge, funds de-risk. Central banks buy for reasons unrelated to your chart. Treasury markets price deficits and policy paths. When those incentives collide, price can move in ways that feel managed because the flows are mechanical. If you want to be a serious observer, focus on what the system forces participants to do. Options, dealers forced to hedge into strength. Levered traders forced to cut into weakness. Physical buyers forced to pay up when logistics tighten. Those are pressures you can respect without inventing secret meetings. And ironically, that approach makes you more dangerous in the market. Because you're not arguing with reality, you're rereading it. And that's where the real pressure starts. So let me pull this together into the concrete payoff I promised. What gold traders watch now, right in this window, is not a headline. It's the triangulation, inflation expectations, real yields, and the calendar-driven structure of hedging. If inflation expectations are shifting in a way that keeps the medium-term premium alive and real yields aren't crushing it, gold has room to stay bid even after a hot run. If the calendar compresses liquidity into the end of January and the options machine is positioned for it, you can get continuation days that look irrational. But if those same forces flip, if real yields jump, break-evens fade, volatility collapses, then the air pocket risk rises, and you want to be the person who already knew what would break the math. Here's the simplest checklist for the next 1 to 2 weeks. And yes, keep it simple because complexity is how you talk yourself into bad decisions. 1, does gold hold above its recent breakout shelf on any pullback, or does it lose it and fail to reclaim? 2, do 5-year break-evens stay firm, or do they roll over hard? 3, do intermediate real yields stay contained, or do they start trending higher? 4, does implied volatility stay supported, suggesting hedging pressure remains, or does it sag, suggesting the reflexive fuel is draining? 5, do you see signs of tightness in the front end of the curve and delivery-related chatter, or does structure relax? You don't need all 5 to line up perfectly. You need a majority. And if you get a majority, you have a map. Now, one last thing before we wrap, because this is where people either build trust with themselves or break it. If you're watching gold because you want certainty, you picked the wrong asset. Gold is the market lie detector for the things that can to be modeled cleanly: credibility, geopolitics, policy constraints, and the public's willingness to believe the currency story. That means it will always be volatile when it matters most. So don't let volatility weaponize you. Don't let a one-day dip convince you the regime ended. Don't let a one-day rip convince you you're invincible. Treat this like a campaign, not a coin flip. And if you want to be part of the small group that survives these markets, be the person who says, I don't need to predict. I need to observe the mechanisms and manage risk. That's the identity. That's the edge. If this kind of breakdown helps you stay calm and actually see the setup instead of reacting to noise, stick around with this community. Because we're not here to worship price. We're here to understand what forces price to move. And we're here to keep each other from getting shaken out at the worst possible moment.